Good morning. Today we will start a new unit on partnership accounts, and this will be the last unit. Partnership accounts. Before going to partnership accounts, let us understand what is partnership. Partnership business is one type of business organization which came into existence for the demerits of or disadvantages of or the limitations of sole trading organizations. In case of a sole trading organization, only one person will have to contribute and he will have to supervise, he have to control, and his entire profit will be taken by him. But the thing is, there are certain limitations of an individual, because he may give more amount, but not that much which will be required for a very heavy investment. For example, nowadays the joint stock companies are making huge contributions, and for that a number of shareholders, thousands, lakhs of shareholders are there. Similarly, if suppose one individual can contribute 5 lakh rupees or 10 lakh rupees, but if we require 50 lakh rupees or 1 crore, maybe 2 persons or 3 persons can join together and they can carry on a partnership. So, they can not only, it will be easy on their part to contribute the capital, but also to supervise different departments like purchases, sales, etc. All these things, or the accounts, all these things can be done by different partners. So, in order to overcome the difficulty of sole trading organizations, this partnership came into existence. Now, in India, partnership firms are governed by Indian Partnership Act 1932. So, here according to Indian Partnership Act, partnership is the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. So, there is no compulsion that all the partners will have to work. Even one partner can work on the behalf of other partners, that is allowed, but the profits will have to be distributed among them, and all the partners will take the profit earned by the partnership firm. The partnership firm has got its own existence, and the partners are different entities. However, the liability of the partner is unlimited. Then we will come to one thing, that is partnership deed. In the partnership deed, all the terms and conditions are recorded. Who will contribute how much, who will take how much profit, what will be the profit sharing ratio, in the event of loss what will happen, whether interest will be given or not, whether your profit will be given or not. All these things will have to be distributed, will have to be mentioned in the partnership deed. Now, in the partnership deed, if the partnership deed is silent about something, then how it will be resolved? So, rules applicable in absence of an agreement, it is there. So, what are the rules? First rule is, they have to share the profits and losses equally. If there are two partners, one partner says I will be taking 3/4, another partner says no, I will not take 1/4, I will take half. So, he is correct, because there are two partners, it will the whole profit will have to be distributed equally, that is 1:1. So, half and half they will be taking. If there are 3 partners, 1/3 each they will be taking, but that is in the absence of any special agreement, or if the partnership deed is silent regarding the distribution of profit or the profit sharing ratio. Then interest on capital. interest on capital and salary to a partner. These are all expenses of the partnership firm, but these are not expenses but appropriations. Appropriation of profit. What is appropriation profit? Unlike any other interest or salary to others, when the partners will take a salary or interest on their capital, it will be possible only when they have got profit and sufficient profit to cover all these things. If they do not earn profit or in case of loss, there will be no question of salary to partner or interest on capital. So, similarly, there are some other do's and do nots. A partner, even if nothing has been mentioned, we have to give 6% interest on loan by a partner. When a partner has contributed his capital, but over and above his capital he has given some loan also to the partnership firm, he will be entitled to get an interest of 6% on this loan, whether there is profit or there is loss, whether there is less profit or more profit. This is compulsory. This 6% will have to be given to him. Then no interest on drawings will be charged if it is not mentioned. Otherwise, if it is mentioned, interest can be charged. Interest on charge on drawings will be an income for the firm. Then every partner must take part in the management. In order to manage the business, every partner should take part in management, in accounts. They must have the access to the accounts of the partnership firm, and also if they so want, they can take a copy out of the accounts. No person can be admitted without the consent of existing partners. If there are 3 partners A, B, C and they want to bring one partner, they can do, but without the consent of all the partners, he cannot enter into the partnership firm, he cannot become a partner. So, these are some rules given in section 13 of the Indian Partnership Act, which we have to follow. Now, capital accounts are of 2 types, fixed capital and fluctuating capital. In case of fixed capital, the capital remains fixed until and unless it is increased with the permission of all the partners. That means, if A has given 10 lakhs, B has given 5 lakhs, suppose they earn interest on their capital at the rate of 10% per annum, this 1 lakh interest, or for that it will be 50,000 interest, will be added and the capital becomes 11 lakhs, and here it will be 5.5 lakhs in the case of fluctuating capital. So, not only interest but also profit can be added and drawings will be deducted from that. So, whatever balance remains, that will be changing. In the beginning, whatever capital was there, at the end the capital may not be the same. So, in that case what happens? It is fluctuating. Opening balance was 10 lakh and 5 lakh, but now it has come to 11 lakh and 5.5 lakh. So, it is called fluctuating capital. Then coming to fixed capital, in case of fixed capital what happens? Interest will be given and your profit will be given, but that will affect another account, not the capital account. In that case, we will have to open 2 accounts. One is capital account, this is your capital account, which will be fixed for all times to come, and there will be another current account. And the current account will be credited with interest, profit salary, commission, etc. So, in this way, due to these things, the current account balance will increase. So, there will be separate accounts for the capital as well as for the current accounts. Similarly, if there are some expenses like interest on drawings, etc., it will be deducted, the current account balance will decrease. In this way, even the drawings will be deducted from this current account, not from the capital account. Suppose you have given 10 lakh rupees, but you want to withdraw 2 lakh rupees, but that will be treated as a drawings 2 lakh, it will not affect this capital account in case of fixed capital system, fixed capital system. Yes. Admission of a partner. So, what are the problems in case of admission of a partner so far as the accounting is concerned? First of all, we have to take the profit sharing ratio. What all we are going to read under admission of a partner is profit sharing ratio. There is old ratio, there is new ratio, there is sacrificing ratio. All these ratios we have to calculate. Suppose there are two partners who are there. Say A is to B, we are sharing profits and losses in the ratio of 5:3. This is the old ratio. Then C is admitted. So, naturally the profit for distribution will be less so far as A and B's share will be concerned. So, C is admitted means he will be taking a share out of it. So, what share he will be taking? There are different ways of calculating these three ratios, that is old ratio, sacrificing ratio and new ratio. Actually, new ratio is equal to old ratio minus sacrificing ratio. Let us take different examples and different situations how these ratios will be calculated. If the new partner share is given and nothing else is mentioned in the question, how it will be done? Suppose A is to B, we are sharing profits and losses in the ratio of 2:1. This is the old ratio. Now, C is admitted for a fourth share or for 1/4. Nothing else is mentioned in the question. How will be preparing the new ratio? How will find out the new ratio? This will be like this. First of all, the total profit is taken to be 1 minus C's share 1/4, that is coming to 3/4, and the old partners will continue to distribute the profits or losses in their old profit sharing ratio. That means, out of the remaining 3/4, A will take 3/4 into 2/3, this is 2:1, that is 3. So, that is equal to 2/4 or 1/2, and B will take 3/4 into 1/3, that is equal to 1/4. In this way, the new profit sharing ratio will be A is to B is to C will be, A will be having 2, B will be having 1 and C will be having 1. So, this is the new profit sharing ratio. A is to B is to C, the new profit sharing ratio will be 2:1:1. When the C, the new partner is given a portion or a ratio, but who have given how much or from whom he has taken, it is not given in the question. We have to take the old ratio. In the old ratio, they will distribute the remaining share. So, remaining share is 1 minus 1/4, that is 3/4, because out of total 1/4 is given to C. So, 3/4 remaining. Out of 3/4, A will take his own share, that is 2/3, 3 by 4 into 2 by 3, it is equal to 2 by 4. B 3 by 4, that is the remaining, into 1 by 3. His share is 1 by 3, 1 by 4. In this way, the new profit share ratio among A, B, C is coming to 2:1:1. Another situation we can take where the new partner in some cases purchases his share of profit from the old partners. Suppose the old ratio was 2:1. So, A was having 2 by 3, B was having 1 by 3. Suppose C takes 1/3 from A and 1/6 from B. Then what will be the new ratio? How to calculate this one? A was having 2 by 3, now he is giving 1 by 3. Not 1 by 3 of his share, but out of 2 by 3 he is giving 1 by 3. So, he is having 1 by 3 only. The remaining portion left with him is 1 by 3. Similarly, this B is giving 1 by 3 minus 1 by 6. So, if he is giving 1 by 6, he will have only 1 by 6. Now, how much C is having? C is having 1/3 from A and 1/6 from B. So, that is 3 by 6. So, in this way the new ratio will be 1 by 3 is equal to 2 by 6, 1 by 6 is equal to 1 by 6, 3 by 6 is equal to 3 by 6. So, when the denominators are same, it is easy to find out the ratio. The new ratio will be 2:1:3. So, A:B to C is equal to 2:1:3. The new ratio will be 2:1:3. This is when the new partner is taking some shares from A and from B. Now, another situation where old partner surrenders a particular proportion of their shares in favor of the new partner. So, this is altogether a different situation where A, B will sacrifice something or some portion of their share. Suppose in an example, A and B, the old ratio is this: A sacrifices 1/3 of his share for C and B sacrifices 1/3 of his share. Now, how much A sacrifices? A sacrifices, this is the question, we are going to solve it. A sacrifices 1/3 of his share was 2 by 3 multiplied by 1 by 3, that is coming to 2 by 9. This he gives to C. Then what is the remaining share with him? We will calculate. And B sacrifices, he was having 1/3, he is giving 1/3 of his 1/3. So, 1/3 into 1 by 3, that is equal to 1 by 9. This also belongs to C. Now, C is having 2 by 9 plus 1 by 9, that is equal to 3 by 9. And what does A have got now? A is having, A was having how much? 2/3. But what he has sacrificed? He has sacrificed 2 by 9. 2 by 3 minus 2 by 9 is equal to 9, 9336 minus 2, that is equal to 4 by 9. So, he will be having 4 by 9. B who was having 1 by 3, he is sacrificing 1 by 9. So, he will be having 9, 3, 1, so 2 by 9, and C is having 3 by 9. So, in this way A is to B is to C, that is the new ratio. A is to B is to C is equal to 4 is to 2 is to 3. If you want to find out the sacrificing ratio here, who has sacrificed how much? A has sacrificed 2 by 9 and B has sacrificed 1 by 9. So, it is 2 is to 1. So, far as the sacrificing ratio is concerned. So, there are a number of ways in which we can determine this old ratio, new ratio and sacrificing ratio. In another case, a partner acquires his share from the old partners in a particular ratio. Like here, for example, Ram and Sam are partners sharing profits and losses in the ratio of 3 is to 1. Ram and Sam are partners sharing profits and losses in the ratio of 3 is to 1. R is to S is equal to 3 is to 1. This is the old ratio. Old ratio between Ram and Sam are 3 is to 1. They agreed to admit Mohan into the partnership firm. Mohan is given 1/4 share of future profits, which he acquires in the ratio of 2 is to 1 from Ram and Sam. Okay. So, now Mohan is having 1/4 share. All total he will be having only 1/4. But this 1/4 he will be taking in the ratio of 2 is to 1 from Ram and Sam respectively. So, from Ram he will take 2 by 3 of 1 by 4 and from Sam he will be taking 1 by 3 of 1 by 4, because he acquires in the ratio of 2 is to 1 from Ram and Sam, 2 is to 1. So, total 2 plus 1 equal to 3, 2/3 of 1/4 he is taking from Ram and 1/3 of 1/4 he is taking from Sam. In this way, Sam has to sacrifice 1 by 12 and Ram has to sacrifice 2 by 12. In this way, if you total these two, 2 by 12 plus 1 by 12 is equal to 3 by 12, which is equivalent to excuse me, 2 by 12 he is taking from Ram, 1 by 12 he is taking from Sam. In this, the total is coming to 3 by 12, which is equal to 1 by 4. Now, what will be the sacrificing ratio and what is the new ratio? Let us calculate. First of all, let us calculate the new ratio. Ram was having 3 by 4. Now, he is giving 2 by 12. So, he is retaining 12 divided by 4, that is equal to 3, 3 into 3 9 minus 12 divided by 12 is equal to 1 into 2, that is 2. So, 7 by 12. This is retained with R, Ram. Coming to Sam, he was having 1 by 4. He has sacrificed 1 by 12. So, in this way it is coming to 12, 3 minus 1, that is 2 by 12. He is continuing with 2 by 12. M or Mohan is having 1 by 4, means it will be equivalent to 3 by 12. So, Ram is to Sam is to Mohan in the new ratio will be equal to Ram and Sam and Mohan, the ratio will be ultimately Ram will have 7 by 12, that is 7. Sam will have 2 by 12, that is 2, and Mohan will have 3 by 12, that is 3. So, this is the ratio 7 plus 2 plus 3, again it is coming to 12. Now, what is the sacrificing ratio? Sacrificing ratio is always calculated by deducting the new ratio from the old ratio. So, old ratio minus new ratio is equal to sacrificing ratio. So, let us see here from the old ratio of Ram and Sam. In case of Ram, it was the old ratio is 3 by 4 minus new ratio is 7 by 12. So, that is equal to 12, 9 minus 1, 7, that is 2 by 12. Then coming to Sam, it is coming from 1 by 4, now he is having 3 by 12. So, in this way 3 minus 10 minus 10. He was having 1/4, now he is having 3 by 12. So, he has not sacrificed anything. From Sam he is taking 1 by 12, na? 1 by 3 into 1 by 4. Okay, 1 by 12 he has taken. 1 by 12 when he has taken from 1 by 4, he was having 10 minus 8, 2 by 12. He is having 2 by 12. He is having 2 by 12. So, 1 by 4 minus 2 by 12 is equal to 3 minus 2, that is equal to 1 by 12. So, in this way it will be 2:1. So, far as the sacrificing ratio is concerned, it will be 2:1, that is Ram has sacrificed 2, Sam has sacrificed 1. So, these ratios will be very useful when we will do the problems on different types of problems. When we will work out, it will be very much necessary. After this, we have to read about the revaluation of assets and liabilities. Revaluation of assets and liabilities. When a new partner is getting admitted into our partnership firm, he may not agree with the assets valuation, whatever is appearing in the books of accounts. Suppose there is a furniture or a plant or machinery which was 40,000. That is the book value. Plant and machinery is an asset, so it is showing a debit balance of 40,000. Now, when he comes, suppose it has been decided that it will be valued not at 40,000, but at 30,000. Revalued at 30,000. So, when it is revalued at 30,000, there is a loss on revaluation. So, how the entry will be passed? The entry will be passed like this. It should be the correct debit balance. It is the wrong credit balance, wrong debit balance. So, in order to bring the debit balance in plant and machinery from 40,000 debit to 30,000 debit, we have to credit 10,000. So, if plant and machinery account debited, credited, then only it is possible. An asset which is standing as a debit balance, if we want to reduce it, it has got to be credited. If it will be credited, which account will be debited? Then revaluation account will be debited. The entry will be revaluation account debited to plant and machinery account 10,000. What is the result? What is the effect? The effect is 40,000 debit your plant and machinery account, which was shown to balance brought down, it was 40,000. Now the current valuation is 30,000. That means it has to be reduced by 10,000. So it will be credited by 10,000. So by entry is revaluation account debited to plant and machinery, or plant and machinery account is credited by revaluation. Plant and machinery account credited by revaluation account 10,000. So henceforth the amount of the balance in the plant and machinery account will be 30,000. So here it will be reflected like this: by balance carried down 30,000 to balance brought down 30,000. See how the effect is revolving through the plant and machinery account. Plant and machinery, which was previously shown in our balance sheet, in the balance sheet of the partnership firm at 40,000, is now coming down to 30,000. How? This is the process. First of all, we will be passing one revaluation entry. The entry is revaluation account debited to plant and machinery, because the plant and machinery account is going to reduce. When the asset value will going on decreasing, then it has got to be credited. Once the asset account is credited, what will be debited? Revaluation account is debited. This revaluation account is a nominal account, and it spells out distinctly what are the increases or decreases in the value of assets and liabilities. So here the effect is revaluation account debited to plant and machinery. So plant and machinery account is credited by revaluation. As a result of this, it has been decreased. If there is no other revaluations, only revaluation loss is 10,000, we can prepare one revaluation account and find out. Let us prepare one revaluation account. Revaluation account debited to plant and machinery 10,000. Revaluation account debited to plant and machinery 10,000. So when the revaluation account is debited to plant and machinery account, revaluation account being a nominal account will be closed. When it will be closed, it will be borne by whom? The balance of the revaluation account will be transferred to the partner's capital account or partner's current account. Partner's current account in case of fixed capital system, and partner's capital account in case of fluctuating capital system. So in which ratio it will be shared? It will be shared in the old ratio. In the old ratio it will have to be shared. So in our example, where suppose A is to B, old ratio was 3:1 and the new ratio is A is to B is to C is equal to 2:2:1, suppose. So in that case it is the old ratio, and in the old ratio this will be distributed. The entry will be, first of all let us close this one, then I shall come to the entry. The revaluation account will be created by A by B in their old ratio. What is the old ratio? 3:1. So 7,500 will be debited to A's account and 2,500 will be debited to B's account. In this way this account will be closed. So now you can mark here, the entry will be obviously revaluation account credited by AB or A's account debited, A's capital account debited, 7,500, B's capital account debited, 2,500 to revaluation account 10,000. If this will be the entry, see revaluation account which was debited with 10,000, now it is credited with 10,000. So, the revaluation account comes to an end, revaluation account is closed. But this is not sufficient to know about the revaluation of assets and liabilities. In the next class, we will be discussing revaluation of assets as well as liability. Now, let us take one more example of a liability. Liabilities account, suppose there are creditors. Creditors were suppose 50,000. Now, the creditors have agreed to give us a discount of 10%. So, if we will be making the revaluation by deducting the discount received is equal to 10,000 or 10% means 5,000, then the creditors should be, the new balance of the creditors should be 45,000. Now, let us come to the journal entry. Creditors account is standing credited, it is a credit balance, any liability is a credit balance. Now, if it will be reduced, that means there is a profit for the organization, means it will be debited. If we debit 5,000, then only it will reduce, because if credit and debit will go simultaneously, then the net balance will have to be the credit or debit. So, here the credit is 50,000, debit is 5,000. So, net credit is 45,000. So, in this way we are reducing the liability. When the liability is decreasing, there is a profit, and for profit on revaluation, revaluation account will be credited. What will be the journal entry? The journal entry will be, we can generate the journal entry by doing this. Creditors is a credit balance. If we want to reduce, it has to be debited. So, creditors account debited 5,000 to revaluation account. Then you can divide this 5,000 among A and B in the old ratio. But here one by one, for each asset and each liability, you cannot prepare one revaluation account. Rather, all the assets and all the liabilities will have to go to the revaluation account, and the revaluation account will explain about the profits earned or loss suffered due to this revaluation of assets and liabilities. So, in short, we can have the revaluation account like this. The revaluation account will be debited to the asset account if the asset is increasing. Revaluation account debited if the asset is decreasing. When the asset decreases, if asset decreases, then revaluation account debited to asset account, because asset account is credited. Similarly, if asset is decreasing, in case of liability increasing, to liability account if decreasing. If increasing, sorry. When an asset value decreases, it is a loss, so revaluation account is debited. When liabilities account increases, then there is a loss, so revaluation account will be debited. So, in short, revaluation account will be debited for each loss, whether it is due to a decrease in the asset or increase in the liability. Similarly, the opposites of this we can write by asset account if it increases, and by liability account concerned liability or concerned asset will be debited or credited if decreases. So, this is regarding revaluation, simple revaluation of assets and liabilities. In the next class, we will be discussing about the memorandum revaluation account along with the revaluation account in a good problem. Thank you.